Today I want to go over some of the truly shocking data that does a great job explaining of why the housing market is where it is right now and why we're likely not to see any meaningful improvements in the near future. Because one of the biggest stories on the housing market lately has been the fact that home sales are at 30-year lows. You guys have heard me say this a dozen times already. Many other real estate channels have talked about this too. And so it's good to look at the comparisons of what was going on in the market back in 1995 to see, are there any similarities? Why are the home sales as slow now as they were back then? What has changed? So here's the deal. In 2024, there was about 4.06 million homes sold, and that's the lowest number that was sold since 1995, when it was 3.85 million units sold. So slightly less, but not by much. Here's the first major thing that people need to look at, which is kind of like an eye-opener and kind of gives you a reality check of, just how bad this current market is though. In 1995, the US population was 266 million, okay? And fast forward to 2024, it's 341 million. And of course, that's just the people we know about, right? Doesn't count all of the illegal immigration we've had over the past several years. That's just the official number. So that's almost 75 million more people 30 years later, yet the home sales are relatively the same. That is truly shocking. Now, when we take a look at this chart here, this kind of breaks down some of the data points I just went over, but also a couple of additional interesting ones here. Here's where things get interesting. The month supply. Back in 1995, it was 4.8 months of supply. So you could still argue it was a seller's market back then, because anything less than 6 months worth of inventory is still considered a seller's market. And then fast forward to today, it's 3.7 months of supply. So not a huge difference, only really 1 month's worth of supply. So not massive. But take a look at the median annual existing home sales price, especially when adjusted for inflation, okay? In 1995, it was $114,600. In 2024, $407,500. But adjusted for inflation, that number back in 1995 would have only been $241,000 in today's money, guys. Close to half of what it actually is right now. So how would you like it if the median price for a home today was $241,000? I think home sales would be through the roof right now if that's what it actually was, right? So there's no two ways to slice it. You look at where home prices were, even adjusted for inflation 30 years ago, they were far cheaper than what they are today. And this kind of makes it so there's no wonder why home sales have slowed down to 30-year lows, even though we have 75 million more people right now, because just looking at that figure alone says it all. They say here how this is such great news for current homeowners, the fact that we've had median sale prices hit all-time highs at $407,500. But the reality is it really good news for a current homeowner? Not really, for a lot of different reasons. If you want to sell, it might be, but if you want to move into a similar house or, still a nice neighborhood, you arguably will be paying even more for your next house, higher price, plus you're going to be getting a pretty high interest rate on that purchase as well. So is that really good news for a home seller looking to trade over to a different house? Probably not. Also, don't forget the fact that with these record high home prices come record high property tax bills and record high homeowners insurance bills that current homeowners have to contend with. So is this really benefiting current homeowners having home prices be at record highs? The real estate industry would have you believe yes. I would argue it is actually the opposite. And some people will say, well, Michael, people can borrow against their house. They can get home equity loans, home equity lines of credit, use that for other investments and blah, blah, blah. Yeah, you can. That's a very risky thing to do because you're putting your house on the line, assuming you're going to be able to repay that extra loan you have against your property. Otherwise, you might lose it in foreclosure. And the reality is, if you have to borrow against your house to do anything, guys, especially at today's interest rates, you don't really have the money to do it. So to me, that's a sign of financial distress. That's somebody overextending themselves and using their equity as a piggy bank rather than just not touching it. Because people who truly have money don't need to do that. Now, the next thing we can look at to draw a comparison from 1995 to today is what were mortgage rates back then? Well, in 1995, mortgage rates were about 7.93%, so not really that much higher than they are today. According to this chart from the National Association of Realtors, it shows that mortgage rates are at 6.72% right now, but the reality is they're a lot closer to 7.2% and even higher than that for most people, unless you have stellar borrowing credentials. Here's yet another stale Miami listing. I actually saw this house back before my California trip last year, and here it is still sitting on the market. Back then in May 2024, it was listed for sale for almost $2.6 million, actually raised the price a little bit from there. And now, fast forward to today, a couple of price cuts later, they're down to $2.3 million. Still no takers, guys. I mean, these houses, they just sit for a year, if not longer, and nothing happens. You know, they actually play games with the prices, and there it goes. It just sits there empty, unsold. Somebody could be living in this house if they would just sell it for a decent price. So, you know, the reason I wanted to bring up the interest rate situation is because everything is blamed on the interest rates. Oh, the housing market's slow because interest rates are too high. Well, we're seeing about the same level of sales, actually more sales than we saw back in 1995 by a little bit, even though interest rates are basically the same. So using interest rates as an excuse of why sales are this slow isn't really true at all. And this recent data proves it, guys. You know, every time you hear from now on in one of these stupid news stories that says, oh, you know, the housing market, it would be so much better right now. All we really need is lower interest rates and everything would be fine. We would just be getting back to those boom years of everybody jumping in and buying homes if the interest rates would just come down a little bit. And you can also really see why people aren't buying houses right now, because it all boils down to affordability, which is not really a huge shocker. So obviously affordability is the biggest problem, right? That's the biggest challenge everybody faces. That's why home sales are at 30-year lows. But when we take a look at how much money you need to as a percentage of your income right now and see how much that has gone up as well, that also further proves how unaffordable housing has become. Okay, because back in 1995, you only needed 19.6% of your income to be able to buy a home. Well, fast forward to today, you need to have 25.2% of your income to be able to buy a home. So those numbers have shot up dramatically over the past 30 years as well. I mean, just take a look at this chart here. That shows you everything. And what you can also see from this chart is the income levels needed to be able to afford a home were relatively stable until this run-up that we saw during the pandemic. Yeah, it went up a little bit right before the last housing crash in 2008, but not by much, not anywhere near as much as we've seen it go up right now. To me, the common sense thing that needs to happen in the natural order of things moving forward is that this chart is going to have to come back down close to that median line there. If you were to just draw a line right through the middle of this, giving you like this long-term average, that's somewhere around where home prices would need to fall in order to become affordable again. Because really the most worrying trend with this whole situation is that younger buyers or first-time buyers, doesn't really matter your age, if you've never owned a home, you're a first-time buyer, are having an extremely hard time getting on the real estate ladder. In fact, a harder time than ever before, because in 2024, the share of first-time home buyers purchasing homes dropped to record lows of 24% of home buyers. Back in 1995, the average first-time home buyer was 31 years old. Today, they're 38 years old. And you can see by this chart here, that this statistic is getting worse and worse by the year. This is not something that's getting better. People are getting older and older. First-time home buyers are becoming older and older, and fewer of them than ever before are able to purchase a home. So that is not good. And that's why I keep telling people that we are up against a huge demographic challenge when it comes to the housing market, because eventually a lot of the older folks that own homes right now are going to pass those homes down to their children or sell them before that. And a lot of those people inheriting those homes will be forced to sell them because they will have no choice. Like, what am I gonna do with this second house? I need to get rid of it. I just want the money. 75% of people who inherit a home choose to sell it for the money. So if we know that to be the case, you're gonna see a lot of homes come up for sale over the next 10 to 20 years, but who's gonna be there to buy them if affordability doesn't see a major improvement between now and then? Probably nobody, right? That's the reality. Probably nobody is going to be there to buy these homes. And if there are going to be people there, then the price is going to have to be severely discounted to be able to match what people can afford. And this is the awakening that people are going to come to realize sooner or later, whether they like it or not. There's no real avenue for home prices to continue going up forever at this current trajectory unless people start suddenly making a lot more money, or the purchase of homes becomes completely subsidized by the government. And they already have their hands in things when it comes to different types of financing. There's FHA financing, there's VA and USDA financing for 0% down. You also have a lot of these private lenders offering their own variation of those low down payment financing programs like Rocket Mortgage, United Wholesale Mortgage, even Zillow Mortgage. All of these guys offer 0% down mortgages today if you qualify, if your income is low enough. But even with all of those incentives and all of those subsidies available, we're still seeing home sales at 30-year lows, which shows you that most people aren't taking the bait. A lot of people are not jumping on this wagon to buy a home because they know that if I'm already strapped right now, how am I going to jump into buying this house and see my monthly expenses go up by 30 to 50% because now I have to maintain this place. I have all these extra expenses I didn't have before as a renter. People know they can't afford it, even if they do meet the lower income qualifications necessary to be able to qualify for these types of subsidies. So it's no wonder that different sectors of the real estate industry are suffering because of this. And besides real estate agents being one of them, the mortgage industry has been taking a huge hit, guys, because think about it. At least as a real estate agent, if somebody buys a house, you're going to get paid regardless of how that house was purchased. If they buy it with cash, you get paid. If they buy it with financing, you get paid. However, the mortgage industry only gets paid if somebody takes out a loan, whether it's a refinance, a purchase, home equity loan, home equity line of credit. Somebody needs to be applying and taking out a loan for somebody in the mortgage industry to get paid. So they lose out on all those cash transactions. So according to a recent study from Boston Consulting Group, they found out that even though there was a ton of layoffs in 2024 in the mortgage industry, that there's still too many people working in the industry compared to the amount of productivity right now taking place in the mortgage industry, which means that we're pretty much guaranteed to see more layoffs in 2025 in the mortgage industry as productivity remains low. They say that the entire industry is operating at excess capacity right now based on the numbers. The median productivity for salespeople during 2024 was 33% lower than the level for the 6 quarters prior to the pandemic. So think about that. Think about seeing that big of a drop in your business, regardless of what kind of business it is, and trying to keep things going. It's going to be very difficult, if not impossible. And they're saying, listen, we should be seeing productivity increasing right now because of the advancements in loan origination systems. We have workflow optimization. We have AI that's helping us now, yet we're seeing productivity go down. How is that possible? Maybe they should take a look at these shocking real estate statistics I just went over in the first half of this video to give them a clue. They say another thing that the mortgage industry needs to work on if they want to see their numbers go up is they need to establish themselves as a trusted provider to consumers throughout the entire homeownership journey, and basically provide the things that people need. Since there's so many people out there that have a 3% mortgage rate at the moment, it'd be better to offer these people a home equity line of credit rather than a cash out refinance in the current interest rate environment, which they're correct, but this is something that everybody needs to be on the lookout for. If you're somebody out there that has a 3% mortgage, you're probably getting hit up all the time from these different lenders trying to get you to take out a home equity loan or a home equity line of credit. Check this out, guys. There's peacocks sitting right on the front door of this house. It's like an albino one. Interesting. But the thing is, most people are not falling for the bait on that either. That's why you're starting to see the mortgage industry crumble right now, because people are not doing this. People are not moving forward with these home equity loans or home equity lines of credit for the most part. Of course, you're having some people do it. You know, we've actually seen those numbers go up over the past year. Now, of course, the industry is trying to be optimistic and say, well, we expect anywhere between 1.8 to 2.1 trillion dollars in volume this year, which is supposed to be higher than the 1.7 to 1.8 trillion we saw in 2024. This is not a very realistic expectation, considering that we have the steepening yield curve right now because bond investors are freaked out about the current situation with inflation and where the Fed has interest rates. It's not looking very likely that we're going to see rates come down anytime soon, which also means you're not going to see a lot of people taking out new loans anytime soon. In fact, most of them who are the people who are desperate or are living beyond their means and using their house as a piggy bank, which end up usually losing the house because of that behavior. And I wouldn't be surprised at all if 2025 is a spitting image of 2024 in terms of how low the home sales are, in terms of how low the amount of people taking out new loans of any kind is, because rates are still too high and the cost of living is pinching everyone's budget as it is. You know, we're seeing all sorts of signs the economy is slowing down and business is starting to crumble for a lot of different companies. You know, there was a major trucking company this past week that filed for bankruptcy. And check this out, between May of 2022 and the end of 2023, a year and a half, we saw 88,000 trucking companies and 8,000 freight brokerage companies go out of business. And I've covered this from time to time, talking about how slow the trucking industry has been. 2024 wasn't a whole lot better because we lost about 10,000 more motor carriers just in the first half of 2024. We don't even know how many losses there were at the second half of the year yet. So the latest trucking company to file for bankruptcy was Wayne Transportation. They filed for bankruptcy on January 10th. They filed Chapter 11, looking to restructure its debts as usual. So these companies are basically operating on fumes. They have nothing left. They have no money to pay their bills. So it's natural you're going to see more and more of them just close up shop. It turns out also that last year, Berkshire Hathaway, which is Warren Buffett's company, they actually shed 4,000 employees over the span of 2024 very quietly, because we haven't really heard much about this until now that it's 2025. And guess what? This all happened at a time when Berkshire Hathaway was still raking in record profits. In 2023, they raked in $37.35 billion in profits, and in the first 9 months of 2024, it was close to $33 billion, and the final figure isn't out yet, so probably pretty close to 2023 numbers. Record profits, guys, but people are getting let go right now. And remember, a lot of these people have mortgages. Everybody has rent or some sort of housing payment to make for the most part. People have bills to pay. So all these people being let go of these high-profile jobs, they're no longer spending as much money. Just like we talked about a couple days ago, how people who make over $150,000 a year right now are slowing down their spending dramatically and on purpose in order to counteract inflation. People are seeing too much money go out the window, realizing life is getting too expensive, and they are cracking down. Microsoft, they're getting serious about firing people too. They just announced that they're going to be firing a bunch of people without severance based on poor performance. Their letter to people who are getting fired says, the reasons for your termination of your employment include your job performance has not met minimum performance standards and expectations for your position. You are relieved of all job duties effective immediately, and your access to Microsoft systems, accounts, and buildings will be removed effective today. Ouch. Also, that means you're losing all your benefits immediately, like your medical care, like your prescription and dental benefits. All of that is gone the day you get fired. Those are also extra expenses people need to figure out when they lose a job unexpectedly like this. Any news story that's going to tell you right now that they expect home sales to pick up and all of a sudden the market's going to get better in 2025 because, whatever. It's a lie, guys. It's all just gaslighting to get people to believe that things are going to get better out of some miracle, because that's really what it would take, is a miracle for things to suddenly get better. But the more realistic thing that's going to happen is we're just going to see a repeat of last year where home prices remain relatively flat, might go up a little bit in some areas, but for the most part, it isn't going to be going up like we saw in the past. Home sales are going to remain at 30-year lows, if not lower, and inventory is going to build, which means we're building towards a better future of the housing market at some point. Because one thing we didn't have for a while was inventory, and that's no longer the case, and probably will no longer be the case as more people look to sell and less people look to buy. So, if you enjoyed this video, make sure you subscribe to the channel, and if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.